Peter Mullineux, Senior Vice President and Investment Strategist for Equity Business Development at AllianceBernstein. Hi Peter, thanks for being with us in Negocios TV.
Hello.
Good
Thanks
day.
for having me.
I would like to ask you about what has driven the outperformance of European value stocks over growth stocks in this year.
Well, this year's been really interesting as European stocks have staged quite a strong rebound compared to the US and other regions, but it's really been driven by the value part of the market. And that's fairly typical if we think about the broad underperformance of Europe in the past. As markets tend to turn, it's usually the most beaten down, the most value opportunities that do tend to rebound the quickest in the market. It's just been really extreme this year, and that's due to a couple of other factors. So if we think about the sectors that have outperformed, it's been within financials and industrials, but diving deeper within financials, it's really been banks, where we've seen rates start to come down a bit. That's general stabilize at least. That's been a more conducive atmosphere for people to make an investment in banks. The profitability tends to be a bit stronger as the yield curve steepens. But also for regional banks, they're showing a lot more capital discipline these days, and they were trading at almightily low valuations, and those have really increased this year. So we've just seen strong opportunities, strong performance from those regional banks. We still think there's quite a lot to go there, and we do have some exposure in one of our European equity funds. The other part that's played a huge role in markets in the first half of the year and has more or less stabilized in the last couple of months has been on defense stocks, where we've seen this ambition from Europe to invest more in defense. I think from our point of view, it's seemingly an ambition. We're yet to see those orders really come through, so we're somewhat cautious on that. And maybe that's reflected in the fact that those stocks, after a huge rally at the beginning of the year, have settled down more recently. So that's been defense within the industrial sector. There's all sorts of opportunities happening outside, but within value, it's really been banks and defense that have driven outperformance this year.
And Peter, talking about Europe, why have high-quality European stocks underperformed this year?
Yeah, it's interesting. We've seen this huge outperformance from value and therefore underperformance from growth. But separate to just growth and value, the quality factor or quality companies have really underperformed growth as well as value. And really we have to step away and think of this idea that stock performance and company performance is really separate to economic performance. Some of the value rebound we've seen has been more economically driven, whereas on the growth side and on quality companies, they've sought to grow their revenues outside of the economic conditions, which have been quite weak in Europe for some time. And so they've looked to expand globally and into the US, and they get a lot of their revenues and operations from the US. And of course, this year we've seen two enormous factors in the market from the US being tariffs and a weaker US dollar. So we had tariff uncertainty. That's been pretty unhelpful for markets. But on a more technical side is, as the US dollar's weakened, those companies that have revenue streams coming from the US or that are priced in the US, when they report up to head office in Europe, they get translated into the local currency we have here, and it just looks a lot worse. So despite some of the underlying fundamentals being there, and results actually looking quite strong in US dollar terms, it doesn't translate into euros or whichever currency they're reporting in. So we've also got to this point where valuations seem to have detached from underlying fundamentals. Companies on the growth side and quality side have been doing well, but valuations just don't seem to be moving in the right way. We think that's a bit of a hangover from the opposite case, which happened 3, 4, 5 years ago in the height of COVID, where quality companies really, really outperformed, and perhaps valuations got a bit more detached on the upper side, and we're trading at too high a premium. In that time, we think it's come back and has gone a bit the other way now. Over time, we expect that these dynamics will normalize, and that ultimately stock price valuations or stock prices should follow company earnings. But we've seen a lot of volatility on that this year, and that's really why quality has underperformed so much.
We are talking about Europe, about the European companies. Are there any European companies that can endure market headwinds?
Well, I think there's a lot of opportunities in Europe at the moment. There's still some opportunities at the value end, thinking about financials and some defense stocks, but also on the growth side and quality, it's really technology. There's some consumer opportunities and some other industrial opportunities. With technology, if you think about what's really driven the market this year, AI hyperscalers, what we have in Europe, we don't have any hyperscalers, but we have these support companies that are actually doing some of the manufacturing behind them, mainly in the field of chip manufacturing, where we have really super innovative, almost monopoly companies dominating the market here, but they just don't have the valuation that investors have put on the US hyperscalers on that side. So we think there's opportunity there. On the industrial side, away from defense, where we will typically look for is companies that have structural growth opportunities that we can align with and that have multiple sources of highly visible revenue streams. So one example might be in the field of air conditioning or heating systems. We're seeing many more countries need buildings with air conditioning in the world. So that's opening up new growth opportunities, but also legacy air conditioning systems needing to be replaced with the latest technology, which is both a lot more efficient and uses fewer harmful chemicals. So companies involved with that have this opportunity to upgrade existing supply as well as install new supply, and they'll often get much more visible revenue streams from maintaining those systems once they're installed than the installation itself. So again, it's all about this visible revenue stream that these sort of companies have. And you see it with the same with machinery, supporting high capital extensive industries like mining, where it's all about maintaining the machines they have. It's funded from operating budgets rather than having to invest in new companies. It's much more stable and less exposed to economic cycles. On the consumer side, Europe's always been a global leader in the luxury part. We have the heritage, we have the brands, we have the history. That's been difficult the last few years. Luxury brands have had all sorts of supply headwinds and demand headwinds coming out of COVID. That's beginning to settle down. But away from that, actually an interesting opportunity is with airlines on the budget side. There are some really well-run budget airlines around that are highly capital efficient, and they own their aeroplanes rather than having to rent them, which provides them with a much more stable cost base and really interesting expansion opportunities throughout Europe and beyond. So really the key is to find the visibility in the growth trajectory and then analyze the company to see that whether they have the management in place who can support that strategy and the culture in place that will support management to ultimately execute on a growth plan.
And the last question, I would like to ask you about the long-term outlook for quality growth companies also in Europe.
Well, the key is always to look for structural growth rather than cyclical growth. I think the outlook for European macro is pretty uncertain. So if investors can act selectively and look for companies where they have more visibility, align themselves with structural growth trends, digitalization, automation, the AI trend where you can access some of that without having to take on the huge valuations you see in the US, really means that hopefully, aside from short-term market opportunity, these strong fundamentals and companies with strong competitive advantages should be well positioned to benefit from these growth opportunities in the future, and ultimately earnings should support share prices over time. So really looking for long-term earnings and cash flows. We think the outlook for companies that almost have control of their own destiny in this way have a pretty positive outlook for the future.
Waiting for Europe, waiting for the Euro close in the next minutes. Peter, thanks for being with us in Negocios TV. It's a pleasure. How are you here? Thank you so much.
Thank you very much. Thank you.